Hi, Tim Hart here from Private Mortgages Australia, and I want to talk to you about our investment opportunities. Private Mortgages Australia is a boutique mortgage manager that specialises in sourcing and managing short-term commercial loans. So why does PMA exist? Basically, we exist to help borrowers that the banking system has failed due to their slow processing times and inflexible lending criteria. Now that means that opens up a massive opportunity for Private Mortgages Australia. In that there's a massive market. There's $250 billion worth of loans that are lent out every year. Now fair enough, the banks have the lion's share of this, but they've got a lot of restrictions and limitations. So they've got processing times up to 8 weeks. And they've got very, very strict lending policies. So they're very strict on who they'll lend to and how much they'll lend. And then you couple with that is they've got a lot of high level of regulation. So they've got your ASIC and your APRA who are making sure that they can't lend to certain limits and that they have restrictions. So all this translates into a massive opportunity for a fast and flexible lender like PMA to take advantage of this and help those clients that they can't. So what does PMA do? So we work with borrowers who are willing to pay a premium for that speed and that flexibility. So we have first mortgages, our borrowers will pay anything from 1% per month, and for second mortgages, 1.5% per month. So what's in it for you as the investor? So we've got target returns of 12% per annum. With all our loans are secured by Australian real estate, and you've got an experienced mortgage manager in PMA who's managing that process from start to finish for you. So there's a couple of ways that you can invest with PMA. So the first one is direct. So this is very simply where you're lending money to a single borrower. So you might be, say, lending $250,000 to a single borrower. That way you've got exposure just to that one client and that one property. So if we look at some of the advantages and disadvantages of the direct model, I suppose the big advantage for a lot of investors, especially your hands-on investors, is that you get to make the lending decision. You get to see all the detail, all the due diligence that we've done for every single loan and decide, is this one for you or not? It can be a short-term investment, so you might want to have some lazy money that you want to put in a loan for, say, 6 months. You can do that with this, so you can have a loan that is very much short-term in nature. The other one, there's no application fees to get in as well. The disadvantage, probably the biggest one there, is lack of diversification. You literally got all your eggs in one basket. So you've got one property or one borrower that you're lending to. If something were to happen or delay, then obviously you've got all that exposure to that one entity. The other big one that we find is investment downtime. That we have investors who come on board with us direct and they get some great returns while they're in the loan, but when the loan gets paid back, they've then got to find another home for that money. Now that could take a bit of time, and so it's that downtime that can really hurt their long-term returns if it's sitting in the bank earning 1%. And the last one is a bit of a disadvantage. It's quite an active investment because you constantly need to be looking at all the documentation and for each particular loan. The other option we've got is the pooled option. Okay, so this is where we're pooling investors' funds to then to lend out to multiple borrowers. So as you can see in the diagram here, it's got a lot of investors coming into the PMAC Trust who then lends out the money to borrower A, B, C, D, and so on and so forth. So one of the biggest advantages of this, especially compared to the direct model, is the diversification. So you might only invest, say, $50,000, but you might have exposure to, say, 20, 30 loans inside the pooled model. It's also quite a passive investment. Once you've invested, that's it. You can just sit back and collect the cash flow. And for a lot of people, that's a big advantage. You've got an experienced credit committee who's making those decisions of which loan to get into and also obviously recovering that money as well. It's much more of a long-term investment, so more of a set and forget. You can leave the money in there for 5, 10 years, whatever you like. So that means that there's no investment downtime. Literally the money just sits there. If we get a loan that's paid back, then that's not your problem. That's obviously PMA. That's our job to then redisperse that and get that out into another loan and working hard for you. And basically the most important one is that regular cash flow, regular quarterly cash flow. So every quarter we'll do a distribution and so you can just sit back and collect that cash flow. The disadvantage, there is some application fees involved because there's a bit of money in terms of setting up this pooling arrangement. And the last one is there's some exit costs. Okay, so if you try and exit or redeem your investment within the first 3 years, you'll lose your last quarter's distribution. Okay, so that's just a bit of an exit cost that we have in there. As soon as you go over 3 years, there's no exit cost involved. So if that sounds like something of interest for you, please click the register button now, and we look forward to hearing from you soon. Thanks.